how the consolidation is done. What is the procedure? So we follow line by line consolidation. To present consolidated results. What does line by line means? If there is a parent and there is a subsidiary, parent will be owning property, plant and equipment, intangible assets, inventories. There will be share capital of parent plus subsidiary, parent and subsidiary, share capital, retained earnings. There will be some liabilities, loans, trade payables. When you add up the property, plant and equipment of parent with the property, plant and equipment of subsidiary, P plus S, this is known as line by line consolidation. Every line item of the parent gets added to the subsidiaries line item. If there is a PPE in subsidiaries books, PPE in parents books, the total will be P plus S. The property, plant and equipment of parent plus subsidiary will be added and will be presented together. The intangible assets will be added and presented together. The inventory is added and presented together. Share capital will be of parent only. I'll tell you why. Because parent is indirectly acquiring the subsidiary through this investment. So there is a line in parent's books known as investment in subsidiary. Now this investment is suppose 200,000. This line will not be existing in the subsidiary because by investing 200,000, parent has acquired the share capital of subsidiary. Now, can we show the liabilities against each other and the asset of one entity, which is a liability of another entity? This is an asset of parent, but this is an indirect liability. This is an investment. The parent is a fully owned subsidiary. There is a share capital of subsidiary, and this is fully owned. So, if parent has invested in subsidiary, subsidiary is kind of liable to pay to parent. So in consolidation, there are some principles which you need to follow. Principles to be followed on consolidation. One, on the date of acquisition, we need to fair value the net assets of subsidiary. This is a requirement of IFRS 3 business combination. If we fair value net assets of subsidiary, there is bound to be an increase in value of an assets, which may also result in emergence of deferred tax liability. Calculate goodwill. When we consolidate, as I said, asset of one entity and liability of another entity cannot be presented in consolidated results because we are treated as a single economic entity, single group. So asset of one entity and liability of another gets cancelled on consolidation. We'll have to eliminate intra-group transactions. Intra-group transactions can be for sale of goods, can be for sale of non-current assets transfer. We also need to value non-controlling interest if the investment is less than 100%. And we have a choice that we can value non-controlling interest on proportionate basis, proportionate share of net assets, or on fair value of the shares. Now, the principal asset of one entity, liability of another gets cancelled on consolidation is the reason for not including the share capital of subsidiary. Why? Because investment in subsidiary on consolidation in P plus S, it will replace, so there is share capital, this investment in subsidiary of 200,000. The net assets of subsidiary represents share capital 100,000, retained earnings 40,000. The total being 140,000. Why would someone pay? And another requirement is fair value of net assets. If you noticed, we need to do some fair value adjustments. We need to fair value the net assets of subsidiary. On fair value adjustment, so there will be a requirement that fair value adjustments. We got to know that land was higher by 20,000. Patent got a value for the first time. Patent worth 25,000 was discovered. Even after fair value adjustments, the total value turns out to be 185,000. The investment in subsidiary is 200,000 and fair value of net assets of subsidiary are 185,000. If I try to cancel 185,000 with 2 lakh, how many of the amount of 200,000 I'll be able to cancel? I'll be able to cancel 185,000, but there will still remain 15,000 in it. What is this additional 50,000 and why a company would pay more than the fair value of net assets of subsidiary? What will prompt them to pay more than the fair value of net assets of subsidiary? What is it which is being paid more than the fair value of net assets of subsidiary? What do you think? Goodwill. So when we pay more than the fair value of net assets of subsidiary, the difference is known as goodwill. The difference is known as goodwill. Goodwill is any amount being paid over and above the fair value of net assets of subsidiary which comes into the books. If I go by the concept asset of one entity and liability of another entity gets cancelled on consolidation, in the parent's books there is a line item known as investment in subsidiary. In subsidiaries books, it is indirectly share capital of parent, retained earnings. These are the line items. In subsidiaries books, it is share capital of subsidiary, retained earnings on date of acquisition if there is any fair value adjustment. These are the line items on the subsidiaries book side. These get cancelled with investment in subsidiary. These get cancelled with investment in subsidiary. Investment in subsidiary gets cancelled with the share capital of subsidiary or retained earnings on the date of acquisition. And in P plus S, only if there is any amount being paid over and above the fair value net assets of amount, it replaces with goodwill. So in P plus S, in the consolidated result, in the consolidated results, it will be share capital of parent only, because the share capital of subsidiary and the retained earnings position on date of acquisition gets cancelled with this investment in subsidiary 200,000. And once it gets cancelled, so this area, date of acquisition balance was 185,000. If I write all here, it was retained earnings position was 40,000. Share capital's position was 100,000. Fair value adjustments 45,000. the total net position on the equity side of subsidiary was 185. This 185 got cancelled with 185 for investment in subsidiary. And any amount over and above this is known as goodwill, only comes into the books of consolidated results. So is the reason in consolidated result from subsidiaries equity, only it will be share capital of parent plus only post acquisition profits. That too in terms of share of profits from subsidiary. Only post acquisition profits are included, because whatever were existing on the date of acquisition, we have paid for it. We paid 200,000 to acquire the position of retained earnings of 40,000, 100,000 and 45,000 on date of acquisition. We acquired it, we have purchased it. So in the equity in consolidated results will be only post acquisition profit. Anyone having any doubt in this? Did you get the concept which I'm trying to convey? Hello? Akash, Bhanu, Birpal, Hema, Manoj, Pankaj, Sapna. Did you get the concept? On consolidation, what will include, what will not include, why we are not including it? Because there is an asset of one entity, liability of another, getting cancelled on consolidation. If net assets value was more than investment, that would be bargain purchase. If I go with the Akash version, 200,000, and if the net investment is suppose 230,000, there's a minus 30,000 goodwill. This is known as negative goodwill. This would have been directly shown as a gain in P&L account. This entire amount of 200,000 gets cancelled with 200,000. So the P&L will suffer by 30. Not suffer exactly. If you look at, we have been successful in buying net assets worth 230,000 by paying only 200,000. So is it a gain? Negative goodwill. It is a gain for the parent company that they have been, they're good negotiators. They have been, it's like Lakshmi Nivas Mittal buying 6 companies and then reviving them. By paying just 200,000, they were able to acquire net assets which has a fair value in the market worth 230,000. So they are good negotiators. There is a gain of 30,000 directly shown into P&L. Is this clear, Akash? Hello, is this clear? I'll discuss goodwill in more detail because I have to discuss valuation of NCI. And valuation of NCI determines valuation of goodwill. I'll show the relationship as I progress. As we progress, we'll touch upon all these items. Loans will be getting added with loans. Loan of parent plus loan of subsidiary. But if there is an intra-group loan, intra-group transactions, it can be loans. If there is intra-group transaction loan between them, how will present it? We'll follow the same concept. Asset of one entity and liability of another gets cancelled on consolidation. If there is a loan being provided by parent to subsidiary, that loan will get cancelled on consolidation because we cannot give loan to each other. Intra-group transactions are eliminated on consolidation. Is this clear? Hello? Any questions till now? Anyone?
Yeah, Amit, if the subsidiary has given a loan to the joint venture where the parent company is involved, how would we treat that?
If a subsidiary has given a loan to the joint venture, then only the proportion of the share in the joint venture associate will be eliminated.
Oh,
On
okay.
consolidation, because it's that one single line item. Okay. Even for your intra-group profits, only that proportion of their investment. But if there is an unrealized gain, that unrealized gain will not be eliminated in full, but will be eliminated only to the proportion of share. Clear?
Yeah.
will negative goodwill be capital reserve because this is unrealized gain? So you're right in one way that in India we take the difference to capital reserve, and in future we'll continue to do the same in IndAS. We'll continue to take this difference as part of capital reserve, will not be showing it as part of P&L. Only in IFRS this difference or negative goodwill is shown as part of P&L. Clear, Pankaj? This is a deviation from IndAS with IFRS. In IndAS, we'll continue to show it as part of capital reserve.